I'm going to speak from down here because you guys know I don't like to be the center of attention, right? So, Chad, why did you look at me like that? Pleasure to be here today and talk about markets. I had to, just sitting there this morning thinking about hearing the rain on the roof. How many times have we heard that in the last little while, sitting at a meeting in June for Stockers? And as many of you know, my good friend Charlie Gracie recently passed away. And I was thinking of him because he spoke at many of these Stockgrower meetings over his history, and how pleased he would be to see us in this room with the moisture that's going on, with record cattle prices, and I kind of felt a warm feeling for him. He really gave me my start in this business. So he hired me in the early 80s, before CCA ever had their office in Calgary. Their head office was still in Toronto at the time. And he really gave this greenhorn a start, and he was such a great mentor to me. So anyways, this presentation is for you, Charlie. So I know many of you in the room have had lots to deal with him over the years. So I have lots to share. About markets, obviously, and I think it's a good place to start in terms of talking about weather. And I also have to caveat, I'm not a meteorologist, but I do listen to lots of them. And obviously, what goes on with weather has a lot to do with our business. And so that's been a key thing. But for many of you that have seen my presentations over the years, and this will be an annual update, this slide that's just showing and I'll talk about Canada in a second here, but this slide showing the U.S. drought monitor as of the end of May is got a whole bunch less yellow and oranges on it than it would have a year ago or 2 years ago. So certainly the conditions that we're seeing going on in the U.S. are certainly as favorable or as good as we've seen. Yeah, there's still a couple of pockets, certainly, that are dry, but for what we've seen in recent history in terms of the U.S. drought monitor, this is a good one. Now, again, not being a meteorologist, but it was basically the change from La Nina conditions that we'd been in for several years that switched last year into an El Nino, which basically saw the change in the patterns that we've seen this year. I don't want to rain on the parade, little pun on words there, but the meteorologists are suggesting for us to, although, especially in the U.S., watch as these weather systems now change again. The experts are suggesting that this El Nino pattern we've been in is already turning into a neutral, which then is followed by La Nina again. And where it affects first is, of course, more deep in the South Plains of the U.S. Before we start to see the conditions move north. So it's something, drought is never off the table in terms of looking ahead. And again, I don't want to start by raining on the parade, but it's something that I think we're going to keep talking about and really watching to see how these systems change as we go through the rest of 2024. Of course, the conditions here in Western Canada have been substantially improved. This is just a cumulative precip since September 1st, quote what they call the growing agricultural season. So great conditions really pretty much everywhere you talk, other than, if you're in the Peace River, there's still certainly some dry pockets up there. So it's not everywhere, but it's certainly substantially improved across the board. And you've heard many of the speakers here this morning refer to these improved moisture conditions and what we've got going on outside of the doors here today in Swift Current. So the other big piece that then comes from this better moisture is what's going on with the feed situation and what that will mean in terms of the impact for feeder cattle and calf prices as we go through the rest of this year. Just looking back to last year, that was the biggest U.S. corn crop ever, and so that's what was put into the bin, if you will. And even though this year's projection with a few less acres being seeded for corn, we're still at this point in time, as of the last USDA report, suggesting that this year's corn production is being forecast at 14.8 billion bushels, down a bit from last year, but it's still going to keep a stocks to use ratio. And if there's anything we're going to watch when we want to talk about price, it's that stocks to use ratio. So keeping that number up in that 14% area. A 14% stocks to use ratio should give us a practical range, if you will, between $4.50 and $5 US for corn. So that's what the market's kind of predicting. That's what it's kind of got in the cards, if you will. And I think I've got, is this big star the, yeah, it is. So that's certainly what's got corn prices trading where they have been really since last fall. We've got, the stocks to use ratio has been give or take 14%, and we've got corn basically trading really sub 470, 475 for quite some time. So that certainly has been a really positive in terms of lower corn prices, lower cost to gain, in terms of being able to be supportive to our feeder cattle and calf prices. So that'll be another thing we watch as we go forward, how this crop progresses as we go through the summer and into the fall. Bringing it to the barley side of the equation, again, looking at the last few years, we've got barley production elevated after the 2021 production, where we saw all of that corn being imported that year. So certainly in a better position in terms of production. StatsCan's last report was talking about a 9.3 million metric ton barley crop, and again, looking at some pretty positive stocks to use ratio for barley in this country as well. As well as corn, same kind of response. You've got barley prices that have really been stuck in this $300 a metric ton basis Lethbridge for most of this year. And even on some of the forward pricing that you can do out into the second half of this year and on even into the first part of 2025, we're looking at prices sub $300 a ton. So again, positive support coming from moisture, coming from better crop conditions, and therefore production weighing on prices that will be supportive to this feeder cattle and calf market. Have been supportive, but I think will continue to be supportive to the feeder cattle and calf market. So let's dive into some of the numbers that go along with starting off with all that good news in terms of moisture, weather, and inputs. So we're going to, obviously spend a lot of time talking about the U.S. beef industry. They drive our prices, and that's a critical piece of really defining where we're going to go in this cattle cycle, is what the U.S. does with their cattle cycle. And on the start of this year, so the last kind of purple line there, if you will, was the 1st of January 2024. U.S. beef cow herd was down 2.5% as expected, so no big surprises there. 28.2 million head is the number. Right now, I'm using my peers at CattleFax in Denver as the forecasts looking forward for these 3 projected years there. They still believe that the U.S. cow herd will still drop some as we start 2025. And basically the reason for that is until we see some retention of heifers, it's going to be a year after that before you start to see any kind of growth in the cow herd. So that hasn't happened, obviously. So still the lows of the beef cow numbers still ahead of us in terms of the U.S. And then where it goes from there, is 2026 any bigger than 25? Where we're going to have to see some heifers retained for that to happen. And then from there, 26 over 25. So the writing's not on the wall yet. We don't know this. We don't know when heifers will get retained, but that will be the next key signal for us. In terms of U.S. beef replacement heifers, Again, a big drop on the start of this year, the smallest replacement heifer number that we've seen in recent history, and that's 50 some years. And we've already seen from the peak of this cycle with the replacement numbers, we've already seen a 25% drop in the number of U.S. replacement heifers since that peak back in 2017 was the peak of the last peak of the heifers. And that's taken 7 years. In other cycles, we tend to see that top to bottom on those replacement heifer numbers happen in about 4 or 5 years. So this one is already looking much more extended in times of it's taken us a lot longer to liquidate, and it's probably going to take more time to grow. This chart, even though it shows some increase as we start next year, when you look, and when I talk again, I'm kind of referring to cattle facts when I talk about what's expected for 2025 and beyond, is they're looking really closely at those weather maps. And if it does start to, producers are we've all come through a very long stretch of drought. And so producers are very, I think, in tune with what's going on with weather in terms of, are we going back to a La Nina and how quickly, especially if I'm a Texas rancher. And so just in contrary to what happened in 2015-16 when the cycle turned quite quickly, lots are feeling that won't be the case this time because we've got so many other different factors, high interest rates, high land costs, the fact that we know more about the weather, or we think we do in terms of what cycles we're in. And so that it could be quite slow. But for now, they're suggesting there'll be some regions, maybe not all of the U.S., but some regions that could start retaining heifers later this fall that will show up in the inventory next year. Again, that's a big if depending on weather as we go forward. Today, as we stand here in 2024, we've still got an elevated number of heifers on feed or in those placement numbers in the U.S. So today, if you would say, are you seeing it yet in terms of heifer retention? The answer is no. All of that leads to, this is the feeder cattle supply basically outside of feedlots. So it's after the calf crop and after we've placed the cattle on feed, what's left to buy in terms of that feeder supply. This number continues to drop. In the first of this year, it was down just over 4%. And again, the smallest number in recent history, and that means several decades. Bringing the supply story back to Canada, our beef cow numbers to start this year were down another 2%. We're sitting at 3.46 million head nationally. And you can see over time, it's basically contrary to the US where we saw a very clear cycle, very clear cycle peak for numbers or prices in 15-16, and then a bottom, and then heading back higher again. In terms of our cattle numbers, we've just continued to be declining pretty much steadily over the last many years. So again, that storyline continues to be the same because we are also not retaining heifers. We saw with the StatsCan numbers to start off this year, replacement heifer numbers versus last year, we're down another 6%. The smallest replacement numbers we've seen in Canada, or this is in Western Canada, the screen I've got in front of you, since 2012. So it's been a long haul of smaller numbers, and that part still has not changed. I'll show you some more data in a second, but the same thing I would suggest in Canada. We don't see, in terms of looking at heifer placements, the number of heifers that are moving continue to be elevated in terms of what's going on feed as we speak today. So right now I would suggest the two countries, US and Canada, are pretty much in tune with what's going on in terms of our cow numbers on our replacement heifer side. We can, through CanFax does a monthly cattle on feed report for Western Canada, and that's where this data comes from. And we know based on their survey how many heifers are getting placed every year. And this slide starts back in 2010. But you can see in the last 2 years, 22 and 23, we had some pretty elevated numbers. The biggest heifer placements on an annual basis since 2011. So again, more confirmation of data in terms of where are the heifers, they've been placed on feed. And so that continues to be the case. And if you just take the first 4 months of this year, January to April, we've got for new data in terms of placement numbers. Even compared to a year ago, heifer placements are up another 2%. So we've had 2 big years. There's no sign just yet of that changing. So those are the things we're going to be watching to help answer the question about when, and some of you might say even if, we're going to change this. So all that leads to the same data series I showed you for the US. The feeder supply here in Canada continues to tighten, down another 2% to start off this year. That's providing this strong support to this feeder cattle and calf market, and that piece doesn't change while we continue to downsize our herd. On to the US cattle on feed report. On May 1st was the last report we have. Finally, we saw US numbers drop below a year ago in the US. So we're looking at this blue line here. So May 1st, we saw numbers down 1% from last year, also down 1% from the 5-year average. So finally starting to see some reflection of these smaller placements starting to show up in these on-feed numbers. April placements were down 6%, so we're looking at that black line. So here's April this year. And so we saw, a slow start in January, some big placements in February, and then they've dropped ever since. So down 6% in April, down 5% from the 5-year average. I really like to look at the 5-year average. We've got lots of volatility in placements, whether it's a weather impact, which was certainly the case in January, but I like to look at more of an extended period of time and compare it to a 5-year average to kind of feel a little more confident about what that number might be telling us. So in the US, year-to-date placements, overall placements are down 4%. And so we expect that to continue as we go through the year, that compared to the previous year, we're going to continue to see placements really all through the rest of this year stay below where we were a year ago. Bringing that back home, again, this is Canfax data for placements for the cattle on feed report for Alberta and Saskatchewan. On May the 1st, on-feed numbers were down 2%, so we're looking at this black line down here, and now we're sitting down 7% from the 5-year average. So we started to see our numbers drop below a year ago, sooner than the Americans did, and also versus the 5-year average. Our numbers are now substantially lower. And same thing, based on imports, and we'll talk about imports in a second, feeder cattle imports, that should also continue to decline based on what we're seeing in terms of cow herd and numbers. The other piece, just to mention, of course, what's one of the impacts of drought, and we would have talked about this the last few years, is you certainly see an increase in placements. Look at 2021. We started placing cattle earlier. Cattle were moving off grass. Well, let's go back to the placement one, first of all. Oh, I've got to go forward. Sorry. We started to see placements jump in years like where we've got the drought. You start moving cattle earlier in June and July, and it really changes that whole placement pattern for our cattle on feed numbers. So here we go with our placements. So far this year in Alberta and Saskatchewan, we do have placements up 2%, but we've kind of been all over the map. Compared to the 5-year average, we're down 5%. So I think, again, as we watch these placements going forward, we're going to continue to see them drop off depending on what we see for feeder cattle imports. And to talk a little bit through this feeder cattle import piece, I think is important. This is a quote, new piece of our supply in terms of talking about our production and our numbers. So historically, again, I've talked about this before, we've been a net exporter of feeder cattle trade kind of pre-2017. On an average, we would have exported about 275,000 head per year over that average of 01 to 2016, so over that 15-year average. Since 2017, though, you can see really there's been a change, and we've turned into a net importer. And on average, in those last 5 years, we've seen average imports of about 150,000 head. So when you think about the full swing of an average exporter, of 275 to an average importer now of 150,000, we've got a net supply change of 425,000 head. So if you wonder how we're filling pens and running these feedlots and packing plants at capacity with this smaller cow herd, there's no question feeder cattle, change in feeder cattle supply has been a key piece in that. And just to look at where we are so far this year, feeder cattle imports here in 2024, and again, they're a little bit all over the map. They're running down 3% year to date. We are averaging about 23,000 head per month coming north. But we just got the April data on Friday, and we saw a big drop in April. So again, is that just, we're also got the U.S. in a position where they're short of feeder cattle. The competition for those feeder cattle to stay south is, more so than maybe it has been over some time. And of course, if you look at our feeder cattle basis, it also has been a very strong position in terms of where these feeder cattle are flowing to or from. But lots of volatility. I think it's something we have to watch on a month-to-month basis. Going back to just the total production picture, because it's one thing to talk about the number of head that we're slaughtering, the number of head that we're placing on feed, whatever the case might be. But I'm going to talk in a minute about what our tonnage is, which is, you have to add the piece in, which is carcass weights. And of course, we've been running at record carcass weights, both in the US and Canada here in 2024. So the USDA did come out and revise the US beef production for this year because of these heavier carcass weights. So first of all, let's just look back a little bit, give you a little bit of premise to go on here. So in 2022, we saw record US beef production in terms of tonnage. It was a big year to move a pile of beef, and they did. And then last year we saw a big drop in tonnage. This year, that first black line, that's where USDA has kind of revised it. It's still going to be down, but not down as much as we were thinking because carcass weights are so large right now. And then as we go into 2025, we're still looking at another 5.5% drop in production and another 2% drop in 2026. So we've still got some big drops in tonnage as we go forward, especially compared to that peak back in 2022. So it's just a question of how that kind of all works out as we go forward. You can tell the slide on the right-hand side is kind of breaking down our fed, steer, and heifer slaughter in the U.S. This last, from 22 to 23, we saw almost 1 million head drop in the number of steer and heifers that were processed. It's going to be a little less this year, but going into 25, CattleFax is projecting another 1 million head drop from 24 to 25 in terms of the numbers of steer and heifers that are going to be slaughtered in the U.S. U.S. cow slaughter, certainly big support coming from a smaller slaughter in terms of both beef and dairy cow slaughter. And of course, that's been huge support to our lean trim or our hamburger beef market, if you will. So first of all, let's just go back and look at, there was the 2022 cow kill, there was 23, and then here's the projection for 2024. Looking at a 700,000 head reduction this year in the cow kill in the U.S., and another 400,000 head reduction next year. Right now, this year, we're seeing reductions coming from both sides. Beef cow slaughter in the U.S. presently is down 13%, and dairy cow slaughter in the U.S. is down 16%. So some big reductions on their way. There's going to be huge support to our slaughter cow market, along with our hamburger beef market, if you will. It is also going to be enticing for imports, and I'll talk about that in a minute, but remember of a lot of the product that both the Americans and Canadians import into our countries are in the form of this lean trim beef. We're both short of it in both countries in terms of what our consumer demands, and so that's the product that is imported from many of the nations we trade with. Let's talk about the same kind of story here in Canada. So again, in Canada, we had production in 22 was maybe not a record high, but it was kind of the third biggest in history. And then last year, we had a 5% reduction in tonnage. This year, I'm reflecting a 4% reduction there. But these carcass weights are going to be a factor. So it'll depend on where we get to in terms of carcass weights, especially in the last part of this year. You can see what's going on with carcass weights this year. I've got the projection in anywhere from 20 to 25 pounds heavier than last year. We're currently sitting heavier than that on average. But you can see over time that we do see some big jumps. The last time we saw a big jump was in 2015 and 2016. The last time we were in this same phase of the cycle where we had big prices and the economic incentive to add weight was a no-brainer, to be blunt. So for example, today in the US, let's just use US numbers to start with, we've got fat cattle trading for $1.85 to $1.90, and the cost of game is like $1.20 US. So it's again, an economic incentive that is driving these heavier carcass weights. The same situation's going in Canada, and that's not going to change in 2024. So we're going to be in some heavier carcass weights. That's going to add some supply. Cattle are going to stay on feed a little longer. But again, the economic signal is pretty clear today in terms of what's going forward. Cow marketing's really expected right now to be down about 8%. They could drop more as we get into the second half of the year. We'll keep an eye on the data. Currently sitting down 7% in terms of our domestic slaughter. So I've got this slide broken into how many cows we kill in Canada in the blue and how many cows we export for slaughter in the red. So we are going to be looking at a smaller slaughter across the board. This should, especially with the conditions that we've got going on out there, we could possibly see this number get into the double digits as we get into the second half of the year. But I'm still going to leave the projection for now at down 8% from last year in terms of our total cow harvest. And kind of just to finish up this supply story, because at the end of the day, it's how much beef are we putting in front of consumers in terms of what drives prices and all the rest of it. So again, leaning on some the U.S. data, first of all, so the per capita supplies, because we've got a growing population in both countries, the per capita supply peaked in 2022. And then last year we saw it drop off. This year we're also looking for smaller production. As we get out to 2026, we're going to see that per capita, how much is available for consumers to even consume on a per capita basis, to drop over 5 pounds per person, or about 9% from that peak in 2022. So, I think lots of folks say to me, well, how are consumers going to be able to consume as much beef as we're producing at higher prices? And my quick response is, well, we've got a lot less for them to consume. So that's what's really driving the supply and demand piece of the equation that's helping to support prices as strong as they've been. So less supply going forward until we get through this next phase of the cattle cycle. Okay, so that brings us quite nicely into the whole talk about demand. And as you heard Tyler talk this morning, when you talk about demand in Canada, you have to also talk about trade, because that's another key piece of our customer base. So we just recently got the StatsCan consumption data, which then gives us the demand data for 2023. And I guess, first of all, yes, demand in 2023 was down 2% from 2022. But I think, first of all, I would caveat that with, look at what's gone on in the last 4 years. So first of all, 2022 beef production was up 3% from the previous year, one of the best years we've ever had. And yes, we're 2% off of that mark in 2023. But these are some of the best demand times we've had. And just a reminder, talking about demand is talking about consumption. It's an index of consumption and price, deflated retail prices. So for example, last year, the Canadian deflated retail price was up 3%. Our consumption was down 7%. That's what left our total demand down 2%. So again, we are expecting some weakness in demand going forward, but we're coming off of some of the highest levels that we've seen. The slide on the right-hand side is talking about U.S. retail demand. And same thing, so we peaked in 22, they peaked in 21. And even though as we go forward over the next few years, CattleFax is suggesting that demand will lose some ground as higher prices slow up some of that consumption going forward, we're still talking about 2024 being one of the top 5 years of US beef demand ever. So again, put it in perspective, we're talking about some great periods of time in terms of demand. And that will be the case as we go forward through this next cycle. We are watching wholesale prices closely. It's kind of one of my best barometers to see on a weekly basis or daily basis what's going on. How are packers getting products sold, at what price level vis-a-vis last year, and what the trends are seasonally. So for example, so far this year we've seen the choice cutout, this is what the slide is of, up 6.5% from last year. Late last year, kind of this orange, I call it scour yellow, but anyways, line, it drifted lower through November and December, and it had everybody kind of scratching their heads. That's not usually when we see a lapse in demand. Usually U.S. demand for beef is very strong from their U.S. Thanksgiving through to the end of the year. And it was one of the reasons why we never got that rally in that fat cattle market late last year to help support the prices through the fourth quarter that we normally do. And so again, demand was weak in that fourth quarter of 2023, and it showed up in prices and it showed up in demand. Here in 2024, yeah, we were off to a slow start, but prices have really held their own. If you take out some of the crazy COVID highs that we saw, and I think you have to take them out of a normal, practical range for wholesale prices, I think as we go through the majority of 2024, I'm going to be looking for that cutout, that choice cutout, to stay between $285 and $315 to kind of tell me that we can sustain cattle prices at these levels with that kind of a cutout. It doesn't have to be sky high. You know, we're trading 6% above last year. I think that's a good enough number to continue to see us trade where we're trading. So we'll watch this kind of a trend. Do we expect prices to saunter lower as we get into the third quarter? Yes, that's pretty typical. And then again, if it's seasonal, we should start to see this cutout improve as we head later in the fourth quarter. So looking for more seasonal movement on the cutout, and really can't be overly critical of what's going on so far today in terms of those things lining up. I just wanted to make this comment on one of the other things we watch on the wholesale market is the spread between choice and select, or in our country, that would be AAA and AA. And so again, it's obviously a grading piece, but we saw when the spread is narrow, it's telling us that the demand is very strong for that select or that AA product. And in this case, what we're seeing is because that U.S. cow slaughter has been so small, and we've got record prices for lean trim or hamburger beef, some of these select products have been taken out of these fed cattle to be ground into lean trim products to support what's going on and the lack of beef coming from the cull cow market. We have seen that price start to recover as we've gone into into June, but all through that second quarter, or especially through April and May, we saw a very narrow spread. This time last year, just as comparison, we were trading that choice select spread near $30, choice over select. Today it's about 15. A month ago it was 10 or 5. So again, it's interesting to watch these pieces come together. They really tell us the supply side, what the demand is for what products. On to the trade piece, and Tyler did touch a wee bit on this, but last year was a phenomenal year, and so far in 2024, we're off to an even better start. So on that side, even though we saw the volume of beef exports down 2% last year, the value of those products that we exported to other nations was up 7%. We hit $5 billion for first time ever in terms of the value of our beef products that we exported. Where are we at so far? Well, just a second before I move on. That's just beef. When I put live cattle into that equation in terms of those numbers, all of a sudden we get our total value up over $6.4 billion worth of cattle and beef exports in 2023. So far in 2024, we're off to another great start. This is better than my projections, which I'm always okay with. But we've already got, and we just got the April data in on Friday, our exports are up 7% in volume, and they're up 8% in value. My projections were expecting to see, with slowing down of our production levels, to see a little less beef move to some of these export markets. But again, we've got record prices, which is supporting the value piece, and we've got some strong exports as well to several nations, particularly the US and Japan, but across the board, we're seeing a growth in exports as well. So hugely supportive on the demand side that we can't overlook. That's a big piece of the equation. I mentioned earlier that when you've got record high cull-cow prices and lean trim prices, you are going to be an attractive market for imports. We saw imports up last year, and I'll guarantee you we see imports up again in 2024. So last year, beef imports from all countries were up 6%. Is that last line on that chart. And if we were to add 2024 in there where we sit today, year-to-date 2024, we're up another 14% on beef imports. So don't see that piece to change. That's part of the whole beef moves to the highest price market, and that's exactly the case when beef is coming into Canada or into the US right now. The Americans are also expecting in 2024 their imports to be up right now. USDA is talking up 12%, while they're expecting US beef exports to be down 8%. So very similar trends in terms of our trade between looking at imports and exports. Okay, let's try to finish up here and talk about prices. Fed cattle prices this year, I'm looking for in the US a 184 average. That will be up 4% from last year. So I think if you get nothing else from, well, I'll show it to you here in a second. But the big year-over-year jumps in prices, in my opinion, were last year. That was the 23 over 22 was the big jump. Can we sustain these prices? Yes, but we're not going to add those same kind of percentages going forward. So a 4% jump this year from last year I think is certainly sustainable. The one difference I see this year that we didn't see last year is return to more of a seasonal trend. Last year the markets just moved higher all through the year. I think now that we're into these higher prices, we go back to what's historically normal. Fat cattle peak in the spring, they bottom in the summer, and they rally again in the fourth quarter. That's what I'm expecting for 2024. What about in Western Canada? Same kind of deal. I'm expecting the fat cattle market to average 240 this year. That'll be 7% higher than last year. But again, expecting the trend to be more seasonal. We're at new record highs where we sit today. Can we trade there for a little bit? Yes, but I also do think as we trade into that third quarter or the end of this summer that we'll see prices ease back a bit. So again, look at a more seasonal tendencies as we go through the year. You know, and again, if you're talking about profitability, we're talking about prices between, you know, as we finish off the rest of this year between 240 and 260, that's where break-evens are. So it's going to be, we need this kind of a market just to hold our money together on these fat cattle. That's kind of where we are. This better market has been priced into the feeder cattle and calf market already. Significant basis improvement. You would have heard, if you were listening to market reports in the first quarter of this year, our price compared to the US price was $25, $30 back of the US market, a very weak basis. Conditions have changed substantially now. We've gotten current. Cattle are caught up in terms of their marketing. The cattle feeders got some leverage. The packer needs the cattle. And all of a sudden, we're back to a very strong basis condition. So again, look at the seasonality there. That's pretty typical. Weak basis in first quarter, stronger in the second. And again, so the question will be as we go forward. But don't discount when you hear people talking about these basis moves. This is significant. So what I've put on the screen is if you've got a $30 basis move, just going, say, from -20 to +10, you're talking about a $400 to $450 a head swing in Canadian fat cattle prices vis-a-vis the US, okay? So these are big numbers. It means a lot. And it's probably, if you talk to a cattle feeder, it's probably his most frustrating part of feeding cattle in Canada, is these wide basis swings that are very difficult to forecast and manage risk against. We've had some quiet support from the dollar. Again, fluctuating either side of 73 cents lately. And that has been positive in terms of cattle prices, beef prices for export. All of those pieces have supported, again, for example, that 7% increase that we've got in beef export sales this year, a 73-cent dollar sure hasn't hurt the amount of beef that we're able to export to other nations right now. Talking about feeder cattle, I do think this year on average for the entire year, including where we started out at, I'm going to call it 338 average. This is on 8.5 weight cattle. That'll be up 17% from last year if I'm at all close. I do think the seasonality is so strong on feeder cattle. I still think we've got a seasonal improvement as we head into September, but maybe not a big, as big a jump over last year, but I still think we've got upside movement in terms of feeder cattle prices to head into that third quarter. Calf prices, I do call the average for the year around 420. That'll be 19% higher than last year if we can materialize that. I also, as you can see my arrow pointing towards lower prices as we head into the fall run. I do think 2024, just like everything else I've talked about, fat cattle, feeder cattle, and calves, returns to more seasonal. What normally happens over a 20-year range in prices in terms of during the year. So I do think prices are going to ease as we finish off the year. Support continue to come from a lower cost of gain. So again, I'm assuming that we get a corn crop, we get a barley crop, all those things continue to unfold how I've presented today. Cow prices I'm expecting this year to average at 165. That's a 23% jump over last year. Lots of support coming from a very strong trim market. We're short of this product, and as again you can see where we're trading today. Seasonality still says that these cows trade lower into the fourth quarter, but we're going to come off some extreme highs here in the second quarter. Over the long haul picture, this is how I would kind of draw my lines if I could. That we still, again, looking back at the big jump was last year, but we still have got a little bit of room to gain as cattle supplies continue to tighten this year, next year, and likely the year after. So, and if that's the case for the US, the same should hold true for us here in Western Canada. So as we see prices move higher there, we have finally started to see it come back into the bread market. Lots will, of course, this is a Western Canada fourth quarter bread heifer average from Canfax reports. So again, so you know where my source has been, but it's the same source all the way through this. But again, it took a long time to finally get this bread heifer marketing gear, but that it did come in line with the calf price by the time we got to the end of 23. So with that kind of going along, we're going to see all classes of cattle move into the next spear as we move higher through feds, feeder cattle, and calves. We'll finish up here because I want to make sure I've got a little bit of time for some questions. We've got to watch the supply piece. Do we start to retain heifers? What happens with carcass weights? Those are important. Weather. We might not worry much about weather. I don't think it's going to change a whole bunch for our conditions in 2024. But do the Americans start to see some drought conditions come back later this year, especially in the South Plains? I think that's a big one to watch to see what the Americans are going to do with their heifers. Consumers and trade, already we've seen solid demand. But beef prices are going to have to stay in line with our competition. Costs, interest rates are going to stay stickingly high, maybe have peaked, but not coming down a whole bunch, versus our lower feed costs. So there's that balance. And we can't take risk out of this market. None of us saw highly pathogen avian influenza coming in March, and it did. So these are always those unknown risks that we have no really controls over. You know, it's a packing plant strike or weather or wars or you name it. We've got lots of risks outside of our supply and demand risks. So with that, I know I've probably gone a little bit over, and I apologize. Rusty, do I have time for a question? Okay. You guys, I hustled there at the end so you could ask a question, so somebody has to ask a question. Okay, Glenn. Oh, we have to share.
Okay, so my question is, one of the factors we take a look at in terms of herd rebuild is heifer placements in the feedlots, and specifically in the U.S., of course. So my question is what percentage of those heifers going into those feedlots are from Mexico? And if USDA separates those.
Okay. Yeah, good question. I'm assuming you heard it. It's in terms of the placements from Mexico. And I don't have the data, but my gut is we've gotten heifer steered data with US from Canada, so I would think they have it from Mexico. I've only ever seen the total number in terms of Mexican placements into the US. It was up last year. You know, in terms of the US, Mexico was also dealing with drought, and so there was more feeder cattle moving north last year, and it was one of the reasons for the inflated placements in the fourth quarter in the US last year. Now, conditions have improved. There's more cattle on feed this year in Mexico, and so my gut would be that there's more staying in the US, but I don't have that split between steers and heifers. But there's no question, and I just want to reiterate, drought does change things. And that's what we saw last year in the fourth quarter. We placed more cattle on feed, more heifers on feed. The Americans did it, and the Mexicans did it. So if those things change, guess what? There's fewer cattle getting placed this year in both the US and Canada, and we'll keep an eye on Mexico. So with our borders being as open and transparent as they should be, we need to watch all of those things. So good call, good catch.
Hi, Zach Nickel. With the lobbying going on in Ottawa right now with the grocery store prices and everything, has that kind of factored into like where these cattle prices will be moving for us in the future?
Okay, you've heard the question. I would suggest to you, my impression would be that the lobby is probably having, okay, you media, don't print this, very little to do with anything. That would be my gut, and I maybe know that's not politically correct, but I think prices are doing what they're doing. They are in line, our Canadian prices in terms of that spread. We're actually above the US in terms of our retail meat prices right now on beef and pork. But I would suggest very little. Oh, you guys are going to let me off too easy. Oh, questions are up. Oh, I have to share.
I'm glad to hear that you got a little optimism because you've kind of been a real pessimist the last few years. So theoretically, how much can we increase the cow herd given land conversion to other uses and the specter of retaining the memory of the last few years of ultra high wintering costs of a cow herd is probably going to stick around for a while?
Yeah, and good comment, Lynn. I think, first of all, I think my answer would be different if we're talking about Canada or the US. So let's talk about the US because that's going to drive our prices, first of all. So I think the US can be more of a typical cycle, if you will. This one more drawn out because it's going to take a little longer, I think, with higher interest rates and possibly some droughts in the US, southern US showing up again. So I do think it's going to be more drawn out, but I do think you can see a cattle herd pick up. Do we ever have to pick up where we've been before with larger carcass weights? No. So I think, that's kind of an unwritten, we're going to see smaller cattle numbers, but it's more the question of what we can produce with that cattle herd. Just like our production peaked in 22 with a significantly smaller herd. Here in Canada, I do think it's a really valid question because we've got more of those layers of tax and regulation and conversion and all of those pieces that demographics, all of those pieces seem to carry more weight. And I think the question could validly be, do we even grow the herd much here in Canada? I didn't answer your question. I gave you a question. A question with a question. So I think I can see where you're going with your comments, and I don't disagree with them. So.
Okay, now I need to cut you off.
Okay, all right.
I'm
Perfect.
sorry. I also need to steal your PowerPoint clicker as well, and I need you to come on stage for a quick picture with Garner. Look at all those instructions. If I can have a round of applause for Anne, she's always such a pleasure.